Yeah, I am, Brian. I think, near term, as I've indicated a number of times, we're going through what I think is a standard seasonal correction. I think we've probably put in the bottom by now, and that people should be buying for the trade. But I think by the time we get into the second half of next year, stocks will have seen the best part of their run, and I think we'll see a bear market, probably maybe 40 to 50% from the highs that I expect to hit, but next May or June.
Okay, we'll get into that. I'm sure Cheryl's got a lot of questions on it in just a second. Let's talk about this rally, though. And it's like a rodeo. They want to stay on for 8 seconds. So where exactly do we stand? If you say we've got a little ways to go, you're talking about a couple weeks, or could this stock market rally have a couple more months of life left in it?
I think we got a lot of life left. I think we've got another 15% or so up to the upside from here. The market is doing everything that you would like to see it do to tell you that this is just a correction. We broke the accelerated downtrend this morning. We got a buy indicator out of the trend indicator last night. We have a divergence occurring in relative strength indexes that are telling you that this is the end, or we're nearing the end of the correction. And given that the stocks traditionally continue to rally until about 6 months before the end of the beginning of a recession, which we think will occur in the first quarter of 2020, that tells us that we probably have room to run yet for stocks.
So bear market call for next year isn't exactly consensus, Scott. I get that you're seeing a recession develop in 2020. What's going to cause that? I mean, is it the trade stuff? Is it the Fed raising interest rates? What do you see so clearly that some of the more optimistic folks that are looking at the data coming in, the confidence data yesterday at an 18-year high, the GDP data, which continues to trend above 3%, the employment data, which continues to point to a multi-decade low in the unemployment rate. What are you seeing that's not a rosy picture for the U.S. economy?
Well, when you look at, for instance, the shape of the yield curve, the shape of the yield curve is consistent with what we would expect to see about 18 months before a recession starts. The monetary policy, every expansion in the post-war era was the result of the Federal Reserve raising rates too much. As I like to say, expansions don't die of old age. They die because the central bank takes them out behind the woodshed and kills them. We see that the Fed has no choice based upon its dual mandate. As long as unemployment continues to fall and we continue to see price pressures mount, they will have to continue to raise rates. They don't have a mandate for anything else. And by the time we get into the first half of 2020, all the fiscal stimulus that we've had that has given us a lift here, if this phase of the expansion turns negative. So you're going to have the confluence of higher interest rates and a drag coming out of Washington fiscal policy, and that's the formula for a recession.